Okay, so we are going to do exercise 8-11 and 8-12 on page 837. And we'll do 8-11 first. So I'm going to put that up here. Okay, exercise 8-11. All right. So let's read the problem first and see what the problem says. It says, Moses Supply Company has the following transactions related to notes receivable during the last 2 months of the year. The company does not make entries to accrue interest except at December 31. And it says November 1, loan $60,000 cash to Seaboard on a 12-month 7% note. December 11th, sold goods to KR Pine Incorporated, receiving a $3,600 90-day 8% note. December 16th, received a $12,000 180-day 9% note to settle an open account from A. Murdoch. December 31, accrued interest revenue on all notes receivable. Instructions: journalize the transactions for Moses Company. Omit cost of goods sold. So we're not going to do cost of goods sold entries, okay? So let's go ahead and get started with this problem. That's weird. Okay. All right. So November 1, loan $60,000 cash to Seaboard on a 12-month 7% note. So we've got November 1. We're going to debit notes receivable because that's what we got, right? We got a promise to pay from a customer. Notes receivable, and I misspelled that, I think, for $60,000. And we're going to credit, cash because it was a loan, so that means we gave them cash. Okay. All right. So that's November 1. December 11th, sold goods to KR Pine Incorporated, receiving a $3,600 90-day 8% note. So this is December 11th. What did we get? We got a note. Notes receivable. All right, notes receivable. And the note was for $3,600. So we're going to debit notes receivable $3,600. And in this case, we're going to credit sales revenue because it was for sale of merchandise. You know, normally we would do the cost of goods sold and inventory entry too, but we're not doing that because we're omitting that for this chapter. Okay. All right, December 16th, received a $12,180-day 9% note to settle an open account from A. Murdoch. Okay, so we have December 31. We're going to debit notes receivable. For $12,000. And we're going to credit accounts receivable because this is to settle an account. Accounts receivable. Okay. So those are the three entries to enter or to recognize the notes. Okay. Let's see. All right. So now it says December 31, accrued interest revenue on all notes receivable. So you have to do these one by one, okay? One by one, we're going to do these. All right, so the formula that we use, right, is interest times rate times time. Principal times rate times time, or face value times rate times time. Pardon me, okay? Face value times rate times time. Face value times rate times time. Okay, so let's do the first one. All right, we have $60,000, right? Times, and that first note is 7% interest. And now we have to figure out our time. Now on that first note, they tell us that it is a 12-month note. So it is a month note. So it's something over 12. Okay. We don't know what it is. We have to figure out what that question mark is, right? So how do we do that? First thing we ask ourselves, is the interest current? Is the interest current? We look at the last time the interest was done to the current date that the note is being paid, or the note that or the date of accrual. Okay. If they don't tell you a date, you assume it's never been done. If this is true, then you do the interest from the date the loan originated to the date you are paying the loan. Okay. Right. If it was done, go from the last time done to the date of payment or accrual. Okay. Okay, so let's look at that. All right. So this problem doesn't say the interest was ever done. So we assume it's going from the date of origination of the loan to the date that we are doing the interest. Okay. So this loan originated on November 1. So it would be all of November and all of December, because we're doing the interest on December 31. All of November and all of December. So we would take that formula and it would become 60,000 times 0.07 times 212. Or another way to put it is you divide the 2 by the 12, 60,000 times 0.07 times 1.1666. Okay. And that's going to give us, for this loan, it's going to give us an interest rate of $700 for the first loan. All right. Okay, let's go to the next one. It's a $3,600 loan, so it's $3,600 times the rate, and the rate on this loan is 8%, times the time, and the time is, they tell us in this loan it's a 90-day note, so it's something over 360. Okay, we don't know what it is yet, so something over 360. So we're going to ask ourselves the question, when was the last time interest was done? If they don't tell you, you assume it's never been done, all right? So you would go from the last time interest was done, which it's never been done, so the origination date of the loan to the date you're doing the interest. So we have December 11th was the date that the loan originated, and we're doing it on the 31st. So 11 minus 31 is 20 days. So 20 days. Or 360 times 8%, and if you reduce that to a decimal, 20 over 360, it comes to 0.0555. So for that loan, it's $16. Okay, $3,600 times 8% times 0.0555. All right. So let's go down to the next one. And the next note is $12,000 face value times an interest rate of 9%, 0.09, times the time. And in this one, they tell you it is a 180-day note. So it's a day note. So that's something over 360. We don't know what it is yet, but something over 360. We go back to the rule that says, when was the last time interest was done? They don't tell us when interest was done, so we assume it's never been done. So we go from the date that the loan originated to the date that we're doing the interest. So in this case, we've got the loan originated on December 11th, or December 11th. No, not December 11th. Oh, I just noticed I did the date wrong over here. It's not December 31 that we did that loan. It's the 16th. Sorry, 16th. December 16th. So December 6th, or the 16th minus there's 31 days in December, means that this loan is 15 days has passed that we have to charge interest for. So 15. So it becomes 15 over 360. And if we take that 15 over 360 and we turn it into a fraction, it becomes 0.0416. So 12,000 times 0.09 times 0.0416 becomes $45. Okay. So now we have $700 interest, $16 interest, and $45 interest. So together that comes to a total of $761. So on December 31, we are accruing our interest. So we're going to debit interest receivable because we're going to receive this money later. We're going to debit it $761. And then we're going to credit interest revenue because we've earned this interest. We just haven't been paid the interest yet. Okay. So that's the posting of the first one is a note, is a loan of cash. We will see that again. The next one is a sale of merchandise. You'll see that again. And the next one is to settle an accounts receivable. You'll see that again. And the next one is accrue interest. And you'll see that again. Okay. All right, so I'm going to stop the recording there.